That's definitely not a balloon with money. It's obviously not helicopter with that as well. And that's not also a glimmer of hope for better future, but that's a probably elevated level of our next debt ceiling of US. And that's what Mr. Druckenmiller said, that the fiscal recklessness recently of last decade has been like watching a horror movie unfold, and that's what we're talking about right now. Is this something that right now we need to really fix? So that's why I decided to really pop that type of finding with Madame, looking at the ceiling and couldn't find anything that might be at the reach of her site. So welcome to next episode of Blockrevision. I had to really repeat this intro, but hopefully everything works fine right now. So let's get to first block of today. All right, block revision also starts live right here, right now. You may pose questions relating the topics I'm covering up. So at first, let's talk about economy view. And that's a horror we've been talking about, horror with that selling projected line of the federal debt held by the public may skyrocket through the roof on the date of 2023 and prolonging right after. So the economy, the markets are expecting that we will really push ourselves into troubles related to the indebtedness, and Treasury is thinking about raising that ceiling of another 1 trillion in bills the next 6 months, and that might be the one of the nails to the coffin when we can find that we are trying to deal with inflation, but on the other hand we are stimulating the market and really pushing ourselves more into this debt levels. So recently we've also found that implied bill funding for next 2 quarters based on recent borrowing estimates looks as that may be pushing us even more into this drain of RRP, that's a reverse repo, and lots of liquidity into the banking sector. So might be drained as well. So if MMF are the marginal buyers, that may happen. So this is why Jeremy Powell don't want that easily backtrack of hiking interest rates. We are right now expecting that may spark out another wave of inflation, and the projected exhaustion that date remains uncertain. But Mrs. Yellen warned US could run out of cash by 1st of June. So we are really scarce of time. Treasury Secretary also claimed that problems, if not fixed, may really prolong in time for some time, and may bring eventually to some catastrophic defaults on the way. That's why it's more likely to devote this inflation than rather the economy, and the agreement may be reached within a few weeks. That's why the markets will be living for what will be the next stance of Senate and the Congress. Markets exuberation right now, we are after this hiking interest rate decision, and we have found, as yesterday we've been mentioning, we have found that 0.25 is the sufficient for now, especially with this demand being tightened, been visible in some of the market gauges, but there are still something that may spark a threat to the already elevated valuation of many commodities and goods and services. So investors right now are expecting that inflation may prolong for future, but as on one hand they expect that it will last longer, why do they betting that we might be cutting interest rates along this year? It's for me inexplicable, as right now the Fed Chair Jerome Powell said that this stop in interest rates may eventually happen, but for now we do find that there are more problems, and these cuts might be out of the possible eventuality. So the average investor is like the stock market is likely to react positively to the expectation of lower interest rates, as lower rates mean cheaper borrowing costs for businesses and consumers, which can stimulate economic growth and increase corporate profits. But going to invest now, as the hiking cycle when they are going to invest now as the hiking cycle is coming to an end, and on the end of this thinking process, it's like yes, the valuation may increase from here, but there is a quite of a risk that the rate pause is already in the cards, and the Fed hints its quarter point hike could be the last of this agonizing cycle, but the market is acting beforehand and always assessing the reality within 3 to 6 months ahead. That's why that might be tricky for those amateurs on the market. So right now, the another things that line up as a consequence, maybe this higher fluctuation of assets reflecting, there is also a second side of the coin. After the stock market slide, there may reappear some of the rumors that Fed is cutting rates due to a weaker economic outlook or inflationary pressures, and that's something that may spark even bigger avalanche. And we are after ECB following Fed decision that was 0.25 basis point interest rate hike. So I will just show you some type of data. Eurozone banks tighten credit. So it was the initial aim of ECB in order to really de-accelerate this type of inflationary speed. So right now the banks are finding a bit more environment to function in, but that's kind of one of the necessity of the problems with inflation right now. So this recently brought us to kind of a hawkish tendency, but it may make a pivot with this dovish objections maybe coming over in the second half of the year. Also, core inflation rate remains still sticky, with core HICP inflation still rising. So ECB projection by 2023 will be at around 5 percentage points, whereas ECB projection for core HICP will be right around 4.5 around. So we will be still above the target, and that's why I don't find, in terms of inflation, of course, I don't find the room to cut the rates, at least by now. All right, so let's get back to our presentation. And that's the question. Is it another victim of high interest rates? So PacWest Bancorp, California-based bank, was one of a possible another troublesome bank that have a problem with liquidity. And if we just bring over to this banking situation and just look back what happened in March, we could find that the right tail of distribution just got cut off, and with other banks are right now going through some turmoils. That's the reality of today. The company Bancorp, PacWest Bancorp has been working with a financial advisor recently and been considering a breakup or capital raise, but a potential outright sale has been hindered by the lack of interest from buyers in the entire bank. So the potential buyer would need to consider potentially booking a big loss, marking down some of its loans. So out of the question who may really turn up for buying one of this entity is one of the largest banks, whether it's Morgan, Sachs, Morgan Stanley, or JP Morgan. As any other bank will probably won't take that type of losses on their behalf. So PacWest already lost about 85% of its value since the beginning of March, and right now looks like it been slumping still. So these regional banks have been in turmoil following the run on deposits and a surge in customer withdrawals, and right now it looks like there is the much more domino elements that are about to fall apart with this another entity. It's very hard to say that the worst is over for the economy, and it looks like the large shark would need to swallow the smaller fish in the reservoir in order to save the economy, and this, I would say, this to maintain this stability within a system. But commercial banks are really important to ensure the smooth functioning of the financial system and to promote economic growth and stability. That's why we cannot get rid of none of those type of facilities, and we need to really just think twice in order to have another types of strengthening stronger major bank and neglecting the fate of those regional. And another thing that may spark the death spiral is this rates. So short sellers have ramped up bets against commercial mortgage rates, wagering that more borrowers will default on office debt as interest costs increase and property values fall. So hedge funds have been using credit derivatives and really piling up against those rates. Right here you can find that amount of leverage and amount of short positions with leverage against those rates of Blackstone, and they are betting that this current reality may cause distress for commercial mortgage rates, and that's something that bringing much more uncertainty for the markets. Many of market participants are so well positioned against those types of facilities that that it may become a self-fulfilling prophecy, that it may fall apart, as there are many of those players that are betting against some turn of events. It may eventually happen simultaneously out of the few different vectors. So this is right now because many banks and institutional investors hold these loans and would suffer losses if there's widespread default. So potential for ballooning defaults right now is more significant than it was before, in my view as well, especially out of this also liquidity issues. Right now, let's head on to crypto outlook, and that's the very interesting turn of events when we can observe there's a uncertainty on many markets. The crypto is playing as if nothing had happened, and this mania from JPEGs, I mean the NFTs, non-fungible tokens, has migrated to memes, and recent beneficiary out of this trend was Pepecoin that recently has skyrocketed by 2.1 thousand, 2.1, yes, 2.1 thousand%, and it would mean that the appetite for risk right now is stronger than it was earlier, and that also coincides with this sales of non-fungible tokens being in a its second wave of interest. So NFTs marketplace is the one that has been really gaining traction in the first quarter of the year. This time is a kind of a meme coins, and that also kind of a mirrors the previous cycle of crypto meteoric rises have been initiated by those NFTs and meme coins. The Dogecoin and Shiba Inu tokens were the ones that were rising ginormously. And so I wanted to speak just few things about this NFT sector. So recently the open interest and the volumes on OpenSea has really slumped, but right after another solution has come over with a lower fees and provisions. That was a Blur. Blur has really proposed a improved type of liquidity and the type of a mechanism that given its users the eventuality of using that type of platform in much more variety of ways. There is a floor sweeping and snipe reveals that are the names that are relating to this type of ease of using. So we can find that this NFTs looks like they are going really nowhere, and this NFTs trend may persist with us for even next bull cycle that may have already sparked or will be ignited somewhere within this year. So there is also an appetite for governance platforms that given its users a vote to a right to vote, and that's why those type of assets are gaining some traction. So we can find there are some common things that giving us an outlook of what we may expect from the next gainers in the future. So talking about Pepe coin, there's not really much unique about this. There was a rebranding recently. The meme coin has gained a traction out of this. Also, kind of a conservative way of looking into these meme coins, and by some group of market participants, it been found as being one of the undervalued proposition. That's why that started being pumped by anonymous type of traders. So that's out of crypto. And why do I really devote my time and your time to those topics? As I don't find that crypto, in terms of decentralization, is the defense of industry of the internet that was true in 90s and started to collapse after this surveillance and other centralization issues has started to turn up back in the previous decade, and right now it's regaining its reputation due to the type of solution. Yes, internet may be a bit degenerated, but the type of stupid things as stupid JPEGs or memes, but it's a kind of a will of freedom in order to have not only the ones right censored things, but also this type of a clutter that everyone can really find out whether it's a useful or not to him. All right, so what about market movers? And right now we are jumping to trading economics, and on macro events we are awaiting ECB press conference. So it's right during our today's transmission, and tomorrow we have non-farm payrolls and unemployment rate out of US. What about earnings calendar? So I will just get you back. Giganormous day today, as we have Apple having its report, earnings report, and recently, as we do know, investor sentiment is still remaining resilient. So if the Apple will really deliver much better forecast, and this earnings than the market expects, we may find a possible pivotal moment for many of indexes that recently has had a much worse press after at least after this Fed's meeting of yesterday. Right now, let's head on to earnings calendar and just look at what happened yesterday. And yesterday we had Qualcomm that was right in point with expectations. Airbus Group. Do you find it properly? Airbus Group, come on, was been diminished, and CVS Health Corp has delivered better data than it was initially been thought. So it's about earnings. Tomorrow we have AMC and ACM research. So there are two of the names to watch. Maybe if you are interested in movies type of stocks related to movies, Warner Bros. Will be yet more to say. It's projections. All right, so we are right now into trade idea study, and I will throw a light on one of the interesting chart that is XAG USD. So you guessed right. It's a silver. So silver right now is trying to get through this ceiling of 26.04, and with this daily type of chart, we can find that it's more likely to form right now a double top formation rather than having another upward try right upside. So right here, after this Fed's meeting, we could find that there was a chance of getting through this 25.8 level, but right now this type of a congestion area of a liquidity right here may stop it as it is. However, this rebound is kind of a satisfactory for both, but for now, as long as we are staying below this 25.86, and as long as this high been rejected, there is more likely that we may go even lower. So for me, the silver is right now in a bearish type of setup to consider, but if we just have a look at commitment of traders, we could find that right here commercials are stepping away and don't buying those valuations as the same as it was back during this previous upside ceiling, I would say. So I do expect that as XAG remaining kind of a extended, I would say that there is more likely to have a correction from here rather than another move upside. Yeah, many do find that there is a cup and handle formation forming up, or any type of wave, but wave or cup and handle formation being depicted right at the markets resistance are normally the point where this distribution starts, and also gold has reached its ceiling, and that's why we need a much bigger power to accumulate in order to push us through this another ceiling in price. Recently also we've seen a copper that has started to make moves downside. That's why I do also expect that there is a kind of a harbinger of a upcoming problems for this type of assets, I mean commodities. So silver right now is for me the one that I would rather qualify as the one been starting a bearish type of a correction. This overextended move is not really tempting for me to trade to the upside, and I would right now reconsider my point of view with this bearish type of trade. So I do expect to have silver go through and cross through this recent ceiling and possibly stop somewhere around this 23.79 where this volume profile is sitting very firmly. So right now XAG USD, it's kind of one of my projection of a trade with a very tight stop loss. We have hit recently this type of high, and right here there is a decisive point for silver, whether we are going up or down. But in terms of risk-reward ratio, for me, it's a much more interestingly to put a short from here. So always remember about risk management, about setting stop losses, and so on and so forth. So that's it in today's episode. Thank you very much for watching, and see you tomorrow at 8:45 to 9 a.m. East.